What a difference a day makes. European equities set for the best day since the noughties as stocks claw back yesterday's losses. Raiffeisen Bank senior analyst in Austria joins me down the line to have a look at the market's goings on and how it's affecting the German economy. Jörg, the story yesterday was that German and European stocks were entering a bear market, but yields on German bonds, for example, have since rose more than 10 basis points on news the PBOC's fifth rate cut. What do you make of all of this?
As you see today, we have further losses in China, but we have a strong counter movement on European and probably on US stock markets. So I think what we yesterday saw was a clear exaggeration, and I think market participants came to mind today and realized that Chinese stock markets plunging are no reason for a sell-off for European or US stocks.
We were expecting the German IFO index to be a main focus. Overall, it actually came in better than expected as sentiment was boosted in August. However, capital investment was down at 0.4%. So what was your main takeaway from the report?
I think the IFO index is a nice sign that the German economy is not booming, but it's developing on a steady state upward path, and fears of a heavy downward movement for the German economy triggered by lower exports, etc., are overdone. So I think the IFO should remind the skeptics out there that it's not the time for doomsday or something like that. And the figures for the German real GDP in the second quarter, I think they were pretty nice, and you can expect at least development in the current quarter, which is at least as good as we saw it in the second quarter. So I think we should not be afraid of some kind of downward movement in the German or in the European economy.
Recent German numbers have been somewhat inconsistent. Only yesterday, Merkel was seemingly concerned enough about what happens in China that she felt she had to weigh in on it. But at the same time, she said she is confident officials will do what is necessary. Now, what do you think central banks can do now? Is QE4 before a US hike likely?
I don't think so, since the fallout from Chinese stock movements, I think, are very, very limited on U.S. real economy, and this is what the Fed is looking for, the U.S. real economy. And we have good development here, improvement on the labor market, and finally inflation will move up when these oil price movements will come to an halt, and then we will see inflation back to 2%. So this is why I think U.S. will go on for a rate hike this year. September is a close call, but I think in December the time has come. And the ECB, of course, as the Bank of Japan, go on for more expansion and will go on with QE. But I think this we saw in the last days coming from China will have almost no effect on central banks in developed markets.
So-called Black Monday was an interesting day for the single currency as it briefly experienced haven status. After the PBOC news, the euro-dollar dropped below 114.56, but what might be the key levels moving forward?
So since I'm convinced that we will see a rate hike in the US this year and further expansion from the ECB, we stick to our call that we will see lower euro-US dollar levels, perhaps 1.05 at the end of the year. But I think the movement we saw, especially yesterday, but also in the days before, with a stronger euro, will not persist in the next couple of months. So if it becomes clear that the Fed indeed will hike rates, I think we have a good chance to see a stronger dollar.
Jörg, great to speak with you. Thank you. Well, today's lineup is all-encompassing, with Louise Macaulay covering commodities and Sam Meredith bringing an economic update on Singapore. So make sure you stick with us here at Dukascopy TV. Goodbye for now.